If you're someone who wants full control over your retirement and wealth building vehicle with the ability to access your money while it continues to grow, this webinar is for you. This is not for anyone who blindly trusts the system to act in your best interest, who assumes your advisor is always telling the full truth, or who believes that simply waiting will make your investments safe. Over the next few minutes, I'm going to show you why most retirement strategies aren't safe as they seem, and the method the wealthy use to keep their capital growing and accessible, tax and penalty free is something very few people outside the 1% ever learn. If you ignore this, the cost isn't just lower returns, it's losing control of your money when you need it most. So if you want clarity, access, and certainty over your wealth and retirement, you're in the right place. Welcome to the Infinite Wealth Strategy, where I'll be showing you the number one financial practice and product there is today. It's been around for about 200 years. The banks utilize it. A lot of companies also utilize it. But guess what? Most people don't know about it. Just don't know. Okay? What is it going to show you? How to become your own bank, access liquid cash, grow your money guaranteed. That's right, guaranteed, no risk, and tax-free. You can't beat that. And that's really only the beginning. So let's get into it. A little about me, very athletic background. I'm still at the gym. I'm still athletic. I'm still very disciplined when it comes to it. I had very humble beginnings, a mother that had 3 kids and raising them on her own. God bless my mom. We didn't come from money. So that gave me the mindset to study money because I need to know. I want a better future for my family and myself. So I said, you know what? I'm going to figure out what's the best. And that's what I did. I'm also a natural entrepreneur that has become a financial professional. So natural talent, I've realized I'm really good at serving others and communicating a message. And I built some small businesses, but it didn't satisfy me. I want to have an impact. I want to make a difference in this life and in this world. So I studied money with an open mind. I didn't have any influence from Wall Street, okay? Came in here with a blank sheet. So why infinite banking? Well, it's the strongest strategy there is for savings, for retirement, for estate planning, for growing your money safely and tax-free. It's really misunderstood by people because of stockbrokers. They do this on purpose because they want you to buy stocks. That's how they make their money. They're all spitting all these lies. And that's another thing I ran into when I was studying this. But I'm here to give you the truth. I'm here to clear the air. And my mission is really just to help you and your family take control of your wealth the best way possible. Okay? Outside of work, you can catch me at the gym, traveling, or spending time with my family. Pretty simple. Housekeeping. So if you have a phone on sound, it's time to silence it. If you have anything distracting near you, it's time to put it away, because this is the most impactful thing you can learn financially. This is the number one practice and product there is. This can change your future and your family's future. Okay, so just be intent, be present, and pat yourself in the back just for being here, because you're investing in yourself right now to learn the secret. Take notes as well. Any confusion, write it down. We can go over it later. So my goal, again, I'm going to transform the finances for you and your loved ones. It's not just about you, but for your loved ones too. It's going to help both of you guys. So it's going to reveal a better system to save and grow your money tax-free. It is the most impactful vehicle you can learn, and it's away from risk. It's not in the market. It has guarantees. You can have a tax-free retirement with this. Tax-free, 100%. And it also comes with estate and legacy planning at its finest, okay? Predictability and peace of mind is the message of the day and the presentation, because we're going to have peace of mind when it comes to our future. That's what we're going to get from this. So briefly, I need to cover core problems because this is a big issue. U.S. debt and inflation, the retirement gamble, and market problems. So covering U.S. debt and inflation, I don't know if you heard of fractional reserve banking. Some people have, some people haven't. straight to the point, the way we create debt in this country is a natural thing we do, and we do it constantly. That's how the commercial banks work. They make about 80 to 97% of the money in circulation. So if you want to learn it, Google it, YouTube it, real quick 10-minute video. You're just going to learn that inflation's here to stay because of the monetary system. That's my point. 2.83% is what we have for this year, 2025. So the real question is, where can we put our money that it can grow safely above inflation? Okay, because it's here to stay, guys. It's not 1 year it's good, 1 year it's bad. No, no, no. Inflation's here to stay. It's going to constantly climb. So we just need a system or a place to put our money to grow safely. Okay, the retirement gamble, 401ks and RRAs, annuities, even pension plans. Take a look. Hidden high fees, often ranging from 1 to 5%. These fees seem minor to you, but they actually add up because of compounding effects, and they could even take up to 1/3 of your money. That's a lot of your contributions just being taken, right? This is your future right here, and they're just taking it. Big problem with these traditional financial vehicles. Now, another thing is market volatility. You see, your money stays at risk. They might sell you the dream. Hey, you're going to be a multi-millionaire. Every year is going to be amazing for you. You're going to hit 12% every year and yada, yada, yada. That's bull. That doesn't happen ever, by the way. So your money stays at risk, and it's considered normal behavior. You can Google this, and you can lose a portion. You can lose half of it or even all of your contributions before retirement. That's the biggest gamble you can make in your life, okay? Now, the biggest problem I have with these, and this is why I never even put $1 single into one of these systems, you're locked out of your own money. That seems so wrong to me from the get-go, from the beginning. You can't withdraw your money before 59 and a half or 60, or you can withdraw it, but guess what? Taxes, 10% fee. We're going to penalize you for touching your own money? Come on, guys. It doesn't make any sense. Your money isn't truly yours until the system says so. It's not right. And this is why this is the number one financial product. Another reason why it's dependable. Its performance is guaranteed to grow no matter what happens in the market. And guess what? Guess what? You can access this money within 30 days of opening your policy, your plan. Because guess what? You are in control. But we'll get into that in a bit. This is the deeper purpose behind why I want to help you in finding the best solution. If you check out my website in the financial insights, you can see all these documentaries made on 401ks, IRAs, and these vehicles that were supposed to help the American people retire good. So many people got ruined because of this. They had to pick up jobs before their retirement. They had to work for another 15 years. This is what could happen to you if you stay on this path. Check that information out. The Retirement Gamble is a great documentary you should check out because it's going to open your eyes to seeing the real problem that's being hidden. Okay? Too much uncertainty when it comes to these vehicles. How much uncertainty do you have when it comes to your financial plan? That's what it comes down to. How much uncertainty do you have when it comes to knowing how your retirement's going to look like, right? Or how it's going to be. There's a lot of questions you can ask yourself around uncertainty. And this is why, again, I want to help you. I think it's one of the biggest things you have to solve, especially in today's world where these vehicles are considered normal, yet they're ruining a lot of lives. And people don't know. People don't know. That's why I'm here to help. That's why I have a job, okay? So what's the practical solution and how are people applying it today? Let's take a look. This is credibility in action, okay? All these people you see here are using it and reported using it. That's right. Even your own banks are using it. Guys, this should blow your mind. There's over $205 billion sitting in this asset from your banks. Okay, you know what that means? That means you're storing your money in the bank. You're getting nothing in return, right? Because they're loaning the money out, they're making money, they're getting rich. But guess what? When you put your money in the bank, they're getting some of your money and saying, you know what? I'm going to go put it in the asset and I'm not going to tell you anything about it. Come on, guys, cut out the middleman. So, U.S. Bank, Citibank, Bank of America, Chase, Wells Fargo, AT&T, McDonald's, Nike. I mean, look at the list. You see it, and it goes on and on. We're barely scratching the surface with this. The Morgan family, the Rockefellers. It keeps on going, guys. These people understand the secret of wealth, this vehicle. So, what do they have in common? What is the vehicle we're talking about? I think you have a clue. It's cash value insurance, either in their business or personal lives. And we're barely scratching the surface with this list. There's many people using it today that are just not famous or, not known like these other companies I put there. So why do they do it? What's the number one reason? Okay, we overcome uncertainty. We overcome uncertainty. I'm already using this. This is my plan. Another word that should blow your mind, Google this. I encourage you to Google this so you can see it for yourself. $205 billion sitting in cash value from banks. That's right, from your own banks. This is on the balance sheet, guys. This is reported. Okay, over 3,000 banks reported using it. 80% of banks with 500 million to 10 billion have this. That doesn't mean you can't have it either. This is an infinite banking policy. Now, Nelson Nash made the concept in the 1980s, but the vehicle was being used even before then. It's a uniquely designed cash value whole life insurance policy. And the infinite banking concept is a way for people to become their own bank by taking control of the banking functions in their lives. Honestly, that's just a part of it. There's more to it. What I like to think of it as, and the most simple way to think of it as, it is a bank account or savings account on steroids with a guaranteed growing death benefit added for good measure. That's just a bonus. That's not even the real benefit. So something you guys got to keep in mind, not all insurance companies are participating in this dividend paying, and not all insurance companies pay a dividend or have high guaranteed interest. But I have done my homework and I got the best thing going for you and myself, so no worries. I'm also certified with Nelson Nash, and you're going to be getting the best thing possible. Again, this is what the asset is: high cash value dividend paying whole life policy, known as the infinite banking policy or the infinite banking concept. It also has other names that you can see here. You may have seen it, you may have not. Now, although it has other names and it's very famous, you guys have to know this. There's so much people pushing infinite banking these days that are just not doing it right. I mean, there's people selling IULs like their infinite banking policies. Worst decision you can make. There's other people using the wrong companies. My gosh, that was a team I was going to join. And yeah, no, not happening. I'm not trying to give someone the wrong product. And there's people just not structuring the policy correctly. This is why I waited 2 years to start my business. I wanted to make sure I knew everything I could. I wanted to make sure I have the best of the best for you and myself, because guess what? My reputation's on the line and I'm doing this for life. Okay? Again, I'm certified with Nelson Nash. You guys aren't going to have that problem with me. You're going to get the best thing possible. I did my due diligence. I did my homework. So, moving on, like I said, I came into this game, into the financial industry with an open mind. I really did want to find the best. So I studied everything, not just this one, but I wanted to see what else is out there. So I made a column to show you why I believe the infinite banking policy is the best. 4 columns I made that I thought were the most important for a vehicle. Is it taxable? Is there penalties? Is there market risk? Is there funding limits? These are the most important questions I found. And the only thing that aced the test is right before you. Cash value policy. It is number one and is the safest. Okay. So how do you capitalize and establish your plan? Let's get to the fun part. Let's get to the fun part. Let me show you what's different. So rule number one, we need to figure out how much we're going to be paying ourselves, right? Like in the book, Rich Dad, Poor Dad, the number one principle is you want to pay yourself first to save money for the future, for investments, and for any of those things, or maybe even buying something cash so you don't have to pay interest, right? Could be those things. So 5, 10, 20%. I don't know what your number is for paying yourself. Everyone's different. But the best place to pay yourself is what? Infinite banking policy. Okay? This is a policy. Bear with me. I am drawing with the mouse. Whoops. All right, so check it out. This is the policy. Policy is made up of two different things. It's so simple, guys. There's cash value up top, and there's this thing called base, okay? Or base premium. So one thing you need to know, most agents do this right here. Every single cent of your dollar, this is what they do. They just shove it right into the base policy. What do you get? You get a death benefit, a nice, expensive death benefit. Wow, amazing, amazing. That's sarcasm, by the way. So why do they do this, though? You guys should keep in mind, whenever an agent does this, and that's why most agents do this, it's a high commission ticket to put money into the base. They're worried about their own pockets. They may guilt trip you into getting this, but they're really just trying to get paid. You see, they didn't do their homework. They're just trying to get paid. Another thing you should know, what do you feel when someone does this? They usually feel like, oh man, this is so expensive. I don't get to see the money. I don't get to touch the money. This is only going to my heirs, which is a good thing, but I can't do much with that. What am I doing? And I agree, you can't do much with it. This is a death benefit play. This is a standard life insurance policy. I do not recommend this for the life of me. Do not do this. Now, let me show you what I do differently. First things first, most of the money not going to base. We're going to be putting 75 to 85% of the money straight into, you guessed it, cash value. That's where we're going. That's what I'm going to do for you, okay? What do we use to do this? A PUA. I can't get into the technical details, but what you need to know about what a PUA is in the policy, when you pay money through a PUA, it pretty much injects it straight into the cash value. And why do we want to do this? Cash value earns guaranteed interest, annual dividends. It grows on a tax-free basis, and it's liquid. You can always access this money, okay? All right. Now, what do we do this for? Very, very simple. Max rate of return and max cash value, because that's the name of the game, baby. That's what we need to do. There's a fine line up here. You can't see it. Imagine that it's there. This is called a MEC limit. Another thing you should be aware of is a MEC limit, but you don't have to worry about it because in today's world, they made it so simple where I literally press 2 buttons on my policy when I'm writing the policy for you, and it says prevent MEC at all costs, and boom, it's not going to happen. It's just that simple, guys. And when I design your policy, we won't be passing that MEC limit. So what's the MEC limit? If you pass this MEC limit, no more tax-free. We don't want that, and it's not going to happen. You see, when I design the policy for you, we get as close as the MEC limit as we possibly can, but we're not going to cross it because we're going to grow this money tax-free, okay? So what's the issue that some of my clients have when this happens? They come to me and they're like, Anthony, I want to put more money in my policy. I'm checking out the growth of the policy. I want to put more money. I'm like, hey, dude, it's all right. You can do it. But guess what? There's only one way to do it. What we're going to do is open up another policy. That's right. Just like how a bank succeeds with a branch that's making profits, You're going to just open up another location. And that location is going to be a policy. You can open up to 2, 3, 4, 5, 6, 40, 60, you name it. Nelson Nash himself had 40 policies before he retired, for your information. And by the way, Joe Biden has reported having 6 policies. Google it, baby. I want you guys to Google it. I studied this with the life of me, okay? So let's see how this looks for somebody. We're going to do a real simple explanation, a real simple example. Follow with me, guys. I'm trying to keep the momentum going. Michael Phelps. I choose Michael Phelps because I wanted to show a 40-year-old. He's currently 40, as you see here. And if you can Google it, you can see that. He's in preferred health, and he's going to be putting $12,000 a year into his savings account, his turbo boosted savings account, okay? Moving on, let's take a look at how that looks, okay? Year 1, we have total premium. That means the amount of money going in, $12,000, as I said, as we established. Let's look at total cash value, right? As we established that it's liquid. $9,900 liquid from the first year. No penalties, no taxes. Isn't that amazing, guys? Isn't that amazing? Okay, look what's happening year after year after year with this cash value. That's compounding. That's true compounding with guarantees and dividends, okay? Let's clear the air as well. Guaranteed column and non-guaranteed. What's going on? Don't worry. It's so freaking simple. Guaranteed column stands for guaranteed interest, no dividends, because the dividends aren't guaranteed. You have no worries. Like I said, I got the best thing going for you. So the company I work with and I got the policy from myself and I'll be setting you up with, they've been paying dividends for 175 years, even over 175 years since inception. That is a lot of years without missing one single year. Okay, that's why I chose them. They also pay the highest dividend rate and hold it for the longest time because it can go up and down. But with them, they like to hold it as high as possible for the longest time. That's amazing. We want the best, right? We want to grow as much as we can. That's why they're number one. I'm going to reveal who that is very, very soon. So anyways, this side of the chart, so much more accurate. We should even look at the guaranteed side. Okay. So in my example here with Michael Phelps, I put that he stopped contributing premiums. You can see it here in this column. He stops contributing at 61 years old. I wanted to show you what happens even though he stopped contributing. Look at the cash value still growing. Why? Because there's guaranteed interest and annual dividends just growing, baby, out of the market. You don't even have to worry about the market. So what else should we look at here? Total death benefit. This plan and this structure comes with a very high growing death benefit. That's the estate planning at its finest, as I mentioned. At any given moment, if Michael passes away, that is a lot of cheese going to his family, okay? They're going to be able to invest that. They're going to be able to live comfortably. They're going to be able to pay off the house. They're going to be able to think about Michael for a very long time and say, you know what? Dad did good. Dad did good, all right? Moving on, you have to also consider the dividends you're earning are being reinvested into this cash value, which is growing and growing and growing, right? What happens with a stock if you earn dividends and reinvest and the stock goes down? What happens? You lose the dividend forever. You can't lose here, guys. It's guaranteed. It's freaking mind-blowing how there's not that much people that know about this. That's why I'm here. Again, that's why I have a freaking job and I love it. So moving on, let's look at this chart right here. 71 years old. This is the same chart, and you can see total cash value on the non-guaranteed side, which is more accurate. Look at those freaking numbers, guys. Look at those numbers. What 70-year-old you know is getting $42,000 tax-free from their policy? I've never heard of a 401k doing that. All right, I'm having too much fun, guys. Look at the death benefit. This is what they call the waterfall method, by the way. I know you probably heard of it. Maybe you haven't. But this is what it's about, guys. It's not that hard to understand. So let's look at the next example I have here for you. And that's going to be, this is the same by the way, 12,000 first year, 9,900 available. Nothing has changed here, guys. Nothing has changed here. Premium outlay, yeah, no, everything's good here. So look, how much has Penn Mutual paid in dividends this year? Google it, guys. I Googled it so I can show you. $265 million for 2025. 6% interest, tax-free. By the way, tax-free. We have to think about what this means. If you got 6% tax-free from the stock market, that's like getting 8 to 9.7% in the stock market year after year after year after. That doesn't happen. It doesn't happen, guys. That's why this is number one. Okay? Look at this. How long has Penn Mutual been paying dividends consistently? Again, over 175 years. And I love this part. This is why I'm doing this. A streak that includes both good and bad economic times. The company has been consistent with this. Okay? Consistent. Wouldn't that be nice to know that your plan for your future, for your retirement, is consistent? So how do policy loans work? We're going to get into the magic now. The banking function. So first thing we need to establish, how much money does Michael have? So let's go back to the chart. We're going to say in year 5, Michael wants to do something. He has $60K sitting in his pretty little savings account, all right? We're going to say this is, let's name it, so we don't forget the topic, okay? This is a policy loan. This is very important, guys. This is what makes more magic happen. This is another benefit, and I got to say it's probably the main one, the main mechanism. So this is our chart. I know I'm not drawing that well. It's a mouse. This is cash value on a chart. Look at that. That's literally how it grows. It doesn't go super fast, but guess what? It's steady, it's always climbing, and it's guaranteed. How does the stock market grow? Whatever the hell that is, okay? And what do we call this? Uncertainty. Uncertainty. Let's erase it. Let's focus on the good stuff. We're talking about good stuff right now. So, as we established, $60,000 available, okay? Let's write it down. 60K cash value. Let's say Michael wants to use 50K for a nice Porsche. He said, you know what, baby, I've been working hard. I got all these gold medals. I think I want to be in a Porsche. All right, I kind of like Porsches too. Okay, so one thing, and the first thing we got to keep in mind, when Michael wants to get 50K from his account, the company doesn't actually take out the 50K from his account. They're going to put a lien against his money. That's right. They're going to go to their general accounts. They're going to say, hey, look, we're going to give you some of our money. This is a real loan, but we're going to keep your cash value there so it can keep growing for you, okay? So what does this mean? That means he's still earning money in the cash value, just like that. It's still climbing, but he still gets to use the money. Doesn't that sound like magic? Okay? Another thing we need to establish about this loan, there is no application, okay? There is no credit check. If you were worried about your credit, don't worry. They don't care, guys. You're safe. You're safe. They understand it's your money. I love that. Control. No credit. Score check needed, okay? What else? What else do we have to cover here? Oh, what can you use the money for, right? Usually with a traditional vehicle, they have restrictions. You can only use it for certain things and all that. You can only use your money for certain things. It's my money. What are you talking about? Anyways, when it comes to this, no questions asked. You want to get your money for a down payment on real estate? You want your money to start a business? You want your money to go on a vacation you feel like you deserve? You want to, I don't know, whatever you want to do, man. It's your money. That's how they treat it. And you know how long it takes to get it? 3 to 7 freaking business days. Isn't that nice? No hassle. You see, in the contract, it states whenever Michael wants his money, Michael's going to get his money. He comes first. Okay? All right. So let's take a gander how this looks like. A 50K loan and the way you repay it, right? And why you want to repay it. So I'm going to share my screen here. We're going to be going to another page. Bear with me. So here we are. We've made it to the loan calculator, okay? Because remember, it is an actual loan from the company. So how does repaying it work? You can actually repay it however you like. 2 months, 4 months, 6 months, 1 year, 2 years, 7 years, you name it. You name it, guys. You guys set the repayment schedule. You're not going to get mail. You're not going to get phone calls. Remember, there's no credit score check. None of that stuff. It's your money. And you can actually set your own repayment for this. So let's say you decide not to pay it back at all. The company's just going to take it out of your death benefit. However, you do want to pay it back if you want to get into the tax-free retirement. So I recommend you guys to pay it back. Okay, it's your money. Just put it back into your account, right? Be responsible. Don't steal from yourself. So another thing, if you want to pay it in a balloon payment, you can also do that. So remember, we have $50,000 that he wants to use for his nice, sexy Porsche. He has a approximate 5% charge for the loan. And he wants to pay it back, let's say, in 5 years. That's about $943.56, as you see here on the screen. Look at the balance go down over time, just like a real loan, right? And so does the interest. Nothing new to see here, guys. So how much, the real important thing we got to get here is how much is he paying in interest in 5 years, right? What am I paying? 6,613. Let's remember that number. We're going to write it down. Let's go back to the drawing board. Okay. Let's go back to the drawing board. Here we are. This is going to be interest he's actually paying to the insurance company. Ow, it sounds like it hurts, right? Man, I'm paying interest. But remember, cash value was sitting in the policy the whole time, earning guaranteed interest and annual dividends tax-free. So we need to pull up another calculator now to see what that grew into so we can really see what has happened here. What is the magic, right? Okay. Going to share my future calculator with you here so we can see how this looks. Remember, $50,000 was still sitting in there. Actually, it was 60,000, but we're just gonna use the $50,000. No need to blow your mind even more. Okay, a monthly, no, we don't need that. 5 years, growing at a 5-6% tax-free rate. We're just gonna call it 5, just for the example here. Calculate, and here we have it, $63,814. So what's the difference? As you see here in the future value, we have 63,814. That is 13,814. Let's go back to the drawing board. Right? It's not hard, guys. It's not hard. 13,000. Drawing what my mouse is, though. 13,814. I'm just going to pull up my calculator here. I'm not going to share my screen. I'm trying to keep this quick for you guys. 6,613 minus that. And boom, here we have it. 7,201 in profit. You see how that works? It doesn't matter that he paid interest. He's still coming on top. There was no opportunity cost lost. It didn't happen. Okay? This is the power of the infinite banking policy. This is the magic. Now let's go a little further. I'm not going to go deep into this part because it can be a little confusing. But let's see. Maybe you're smart. Maybe you can catch on. Okay? Let's say this is the example we're going to play. Okay, guys? Remember, he has 60K in there. We're going to say, let's forget about the loan he wants to take out right now. Okay. We're going to say he has this time he's financing a car. He was financing a car for $50,000. He's paying 12% interest to who? To a company, a financial institution, to a bank. They're profiting on that 12%. He's not earning anything on that. That's money he's giving away and never going to get back. Okay? So what happens when Mike says, you know what? My retirement vehicle, my savings account actually I have that money and I could pay myself back and earn it. So why don't I just take out the 50K, get rid of their loan so I don't have to pay them interest. I'll just pay myself. I'll pay myself the interest. So remember, 12%, that's a lot more. And now he only has to pay 5% over here. But Michael says, you know what? I want to pay myself the same rate I was doing to them. Because why not? I would like to pay myself the same thing I was doing to them. Why do you want to do this? It's not like it's going to pay the loan quicker. That's why. So it actually, the additional money actually goes to his cash value. And you're going to see the power of that in just one moment. So let's go back to the calculator here. Very quick math. Let's say, again, 12%, 1,112. We're just going to write down those numbers. What is 5% that's actually needed for his loan that he took out with himself? 943. Okay, we're going to keep it simple math. What's the difference here? Again, I'm going to pull out my calculator real quick. You guys probably can't see this. Don't worry. I'm sure you have one on you. You can verify. Minus 943. I'm getting 169. I'm sure you guys are getting the same thing, right? So 169 is the difference. 12%. 169. And by the way, look at how much interest he was going to pay someone else. That's $16,000 going to someone else he will never see again. So what we have to do to figure out the additional money he's actually going to be paying himself, it's going to be, here, I'll show it to you guys. 169 times 5 years. What is that? 60 months, I believe. That is $10,140 he gave himself. So he went from losing $16,000 to now gaining $10,000, but not only gaining it, but putting it into a vehicle that's now going to grow guaranteed with annual dividends and tax-free. Guys, this is the number one financial strategy. This is what the wealthy are doing. This is why they do it, okay? I'm just breaking it down for you so you guys can comprehend it. People try to make it complicated. You don't have to, okay? Okay, now let's get to the next fun part about this. This is the one that excites me the most. This is the one I love the most because people are like, what? Income, tax-free retirement, right? I'm going to show you how it works. Again, we're going to have the same example in front of us. It's going to be Michael putting in a simple $12,000, getting $9,900 available the first year, and money growing, so on and so on, right? Same thing going on here, but let's look at the premium outlay. That's an ugly arrow. Whatever. As you can see, he decided to cut back at year 61 to 2,335. 335 going in. Just to show you another amazing thing. $24,000 profit tax-free for $2,300. What 60-year-old do you know is doing that? That's remarkable, guys. It doesn't happen, okay? Only here. We're going to get to the point now. So, Michael, look at the premium outlay. Michael decided no more money. As you see with these O's, these zeros, okay? No more money going in. Again, what is happening with the cash value? As we see in this column here, I'm just trying to break it down and simplify it for you guys. Money is still growing, guys. It's still growing for a certain amount of time, but it starts evening out because he's taking out money too. As we see here, in the income, he's taking out $25,000, and he's going to be doing this for 25 years till he's 90. $25,000 tax-free. That's like getting $45,000 taxable, right? You guys have to remember it's tax-free. That's very powerful stuff. And he can decide to maybe not get it one year, maybe get it the next year, maybe stop for a couple years. It's up to him. Full control, guys. Full control. I forgot to also mention something that's very important in the presentation. There's a myth out there that there's no flexibility when it comes to these policies. Complete bull. So, we established he's putting $12,000 to savings every year. At any given moment, Michael can switch to that 23.35 rate. If you break it down, it's about $190 a month. He can go from $1,000 a month to $190 a month. You can do this by a simple phone call to the company. It's that easy, guys. It's that easy. Hey, I'd like to switch it to this for this long. That's it. If you ask me, that's a lot of flexibility. So don't feel like you're trapped or stuck into paying $12,000 a year if something goes rocky, whatever happens. You have flexibility. You have peace of mind when it comes to this vehicle, which is why I do it, okay? So again, let's go back to here, $25,000 tax-free. I have to pull the calculator out. Let me share it with you guys. What does that look like? $25,000 tax-free for 25 years, right? 25,000 for 25 years. Look at this. This is tax-free income for Michael. $625,000 tax-free. And look what he put in. This is the best part. Look at this. He only put in, it says it here in the cumulative premium outlay, $251,000, $677. That's all that went in. We're going to write this down because guess what? We're going to do quick math and see what's straight profit for Michael. 251,677. $373,000 profitable, tax-free, predictable. It's not at risk in the market. You see, someone's going to be crying out there because they were risking it. If you're all market, you're all risk. And they might even have to pick up a job because the market crashes and takes 15 years just to bounce back. That's the big issue. But no, Michael's going to be sleeping well because he did the most predictable and most safest thing possible. Okay. What does this look like as well? 625. Let's say Michael graduates at 90 years old. As you can see here, that's 755,000. Let's add that up. 625 plus 725. Was it 25? Sorry, it was 755,000. Let's see. 755,000 plus 625,000. That is a whole lot of money for Michael and his family. Okay. He just took care of himself. He took care of himself, and now he's even taking care of his family. You see, this is the most powerful, the best freaking strategy you can have in your life, with guarantees, annual dividends on a tax-free basis, guys. And it's liquid, constantly liquid. Within 30 days, you can access your money. You can have this in your life. This is certainty. This is predictability. This is you taking care of yourself and your family. What more can you be asking for, guys? So let's say Michael got committed with his system. You see, Michael said, I like this. This is safe. This is predictable. This could be like a bank account that earns money, right? Because it's liquid and it's not at risk with the market. So you know what? I'm going to increase the volume of what I'm putting into my account. I'm going to go all in on this strategy. What does that look like? And you know what Michael said? I got 50K sitting in the savings account, not earning anything. Guess what? I'm going to toss that baby in there as freaking well. So now Michael has become committed. Michael is setting out to really use the wealth strategy the way it's made. Okay? Michael here, the same old Michael, 4 years old, preferred health, but this time he deposited $50,000 immediately into his account. Why? Because the way these policies are structured, you're allowed to do a large deposit within the first year without causing any taxes to happen. That's right. So you can turbocharge your savings, your contributions. And Michael also said, you know what, instead of funneling $50,000 to my bank account, I'm just going to funnel $50,000 to my bank, okay, my banking policy. Let's see how this looks like. Year one, $100,000 in, and immediately $83,000 available. That's liquid, guys. He's able to use this immediately. It's not locked away. There's no penalties. It's not at risk. It's immediate. And look at this guaranteed cash value growth with annual dividends, tax-free. Look at that growth. Look how fast it's growing now because he turbocharged it. That's freaking amazing, guys. And he could take the money out and still have it earning. It's powerful stuff. It's remarkable. Nothing else does this. This wipes out the whole playing field of other financial products. Okay? And we see here year two, it's the 50,000 contributions. Like I said, he wants to start channeling 50K into the savings account a year. How does this look like when he wants to retire? Oh, another thing. Look at the freaking death benefit over here. Look at those numbers. Do you think you'd be able to take care of your family with this? You're going to be leaving them in the best place possible, guys. This is tax-free wealth being transferred. You're taking care of yourself and you're taking care of your family. How much can you take out? Look, 66. Michael, again, premium outlay is done contributing. What is this going to look like for Michael? $142,000 tax-free every single freaking year for 25 years. That's a lot of money tax-free. Look at the death benefit for his family. It's still remarkable, guys. It's still remarkable. Look at the cash value, what it's grown to. Wouldn't that be nice to have for your retirement? Wouldn't that be nice to have and not have to worry that it's being risked at the market, that it's being locked away? Okay, so let's see. $142,000 for 25 years. Look at that. Look at that money. That's amazing. Okay, what else do you want? That's $3,550,000 tax free. Excuse me, I'm a little excited. This is amazing, guys. This is why I do this. It's just better. It's simply better. How much money went in? We can look at it again here. Cumulative premium outlay, 1,142,000. Let's subtract that. Look at this. That is $2,408,000 profits, tax free. That is what he's getting out of this. Isn't that amazing? This is crazy. And you add this, let's say he graduates at, let's say 75, 3,252,000. Is that right? Yes, it is. So we're gonna go plus 3,252,1. Okay, boom. Look how much money he's getting for himself and his family. Okay, and it was never at risk. Isn't that amazing? Guys, you can have this in your life. This is certainty. This is predictability. You can have this for you and your family. That's why I do this, guys. Okay? So what are we getting out of this? Why should this stand out as the right choice for you? Guaranteed interest, annual dividends, compounding tax-free. It's free of fees. Remember, they could steal 1/3 of your money through fees. No, there's no fees here. You're free of that. It's free of market volatility. And it's inflation proof. Why? Remember, inflation's eating 2.73% a year, and it's increasing every year. But this is guaranteed to grow. Inflation proof as well. And most importantly, you should be getting peace of mind with this financial system. Okay? Remember how much people are using it. This is why the banks have their money in it. This is why they utilize it. This is why McDonald's, Nike, Walt Disney all utilized it before, and many, many others. This is just popular names you're familiar with. There's so much other people using this. Okay, but not enough. Not enough, okay? There's too much people getting screwed over with 401s, IRAs, Roth IRAs. It's ridiculous, guys. The amount of stockbrokers out there that tell you if it crashes, when it does, they tell you just hold. You only lose if you sell. That is not peace of mind, guys. What are you going to do? Pick up a job for 15 years until it bounces back? That's not peace of mind. No, thank you, stockbroker. Michigan. Jim Harbaugh also had this being utilized for his contract. As you can highlight here, if you're worried, I don't have that much money, these guys are wealthy, you can start at a very low level. It's still very impactful. It's one that can also be incredibly effective on a much smaller scale. It's very true. That's how I started. You can start the same way. It's fine. Joe Biden, again, ex-president, reported having 6 of these freaking policies working for him. Quick recap. What are we doing with this? Savings account on steroids, loans for yourself, for business, real estate, cars, vacations, you name it. It's your money. It's your money. Be at ease. Be at ease, soldier. Okay? Pay off higher interest rates, debts, and repay yourself. Beautiful, very smart. Tax-free retirement income, and estate and legacy plan. Guaranteed interest. It's liquid, guys, within 30 days of opening. It is protected from lawsuits, creditors, and bankruptcy in most states. It is tax-free growth and tax-free wealth for your family. It's an estate plan. And most importantly, what you should be getting from this is what I got from this is peace of mind. Okay, sleep well, sleep well. The market crashes, they're going to be panicking. You're going to be sitting nice and tight, cozy with a cocoa drink in your hand. All right. Thank you for joining my webinar on the infinite banking concept. If you have any questions or want to see how this strategy could look for you and your family, book your call on the Infinite Wealth Strategy site using the link below. Go all the way down to the website or click Let's Connect at the top header, and I'll see you on the inside. Thank you guys so much. Take care.